Now we move to Asia. We heard a little bit from our last speaker about Japan, but now we go really into Asia. Our speaker here will be Rocky Tung. He's the economist of Coface in Asia, covering the Asian market. He's visiting us this week, had already a couple of presentations at the West Coast and now in New York. So finish up with Asia.
I'll grab this. Thank you very much. Thank you very much for having me, Guan, Kirsten, and organizers. I really appreciate the opportunity to be here with you today because the lineup was great. I really learned a lot from the other speakers. So what I'm going to do is talk a little bit about Asia Pacific economics. First of all, I'm going to talk very briefly about certain slides regarding the global scenario, and those would be covering what matters really to the Asia Pacific economies. Then I'll move on and talk about Asia. I can't talk about everything under the sun, so I would just talk about certain economies that I've picked up. Then I'll focus more on China. That will be the bulk of the presentation, and after that I'll introduce to you what we do here in Coface. Besides the talking, we are going to introduce to you what we do as business climate assessment and country risk assessment, which is unique in a way. So bear with me. We here in Coface, we believe that economic growth in the world is going to pick up this year, which is very much contributed by, the U.S. We believe that the U.S. economy is going to pick up to 2.9% growth comparing to the 2.4% that we saw in 2014. That is going to contribute some 0.7% growth to the global growth of 3%. That is the difference maker between 2014 and 2015. So bear in mind, this is the assumptions for our later presentation on Asia. Regarding the oil price, we have already heard a lot about this. In Coface, we believe that the lower oil price in the world is actually benefiting to the US and definitely Asia. In Asia, besides Malaysia, most of the countries are actually benefiting from the low oil price. It's because Malaysia is a net exporter of minerals and commodities. So besides Malaysia, like I said, the other economies are going to benefit from the low oil price environment. In terms of sectors, here I would like to talk a little bit about chemicals because it would matter in the later part of this presentation. Chemicals, as you may see, a chemical sector should be benefiting from the low oil price environment. However, as we see in Asia, it's not quite the case. Why is that the case? It's because when oil price in last year, when oil price was around $80 and your customers actually make their orders. After you do the manufacturing process, you send your goods to your customers. Well, crude oil was already at $50 per barrel. So your customers would be asking you for a lot of haircuts, a lot of discount in terms of your product price. But then you have to consider that these producers actually ordered the input when oil price was high. So that was actually creating a lot of disruption to chemical manufacturers in Asia. And we are receiving rising claims from that particular sector. So that would be something to take note of. Okay. After the very brief overview of the global economic environment, then we talk a little bit about Asia. So Asia in general will be seeing growth of, we'll be seeing similar growth as last year. However, it will be contributed less by China now. China is going to be slowing down to 7% this year comparing to 7.4% that we saw. But we see the likes of the others like Philippines, India, picking up the slacks. So some contribution of growth will be coming from these other emerging markets. Also, last year in Japan, we were actually quite optimistic at the very beginning, but then we saw the reversal of optimism. So we hope this year is going to be different. And with Japan growing at 1%, that will be contributing to picking up the slacks from the slowdown in China as well. But we are essentially talking about very different markets in Asia, and at least I personally hate to group Asia as a group. We like to talk about them in individual economies. Why is that the case? The highlighted countries here, or economies rather, because Hong Kong is not a country per se. So the developed economies in Asia certainly have advantages of being easily doing business in those areas, and the logistics would be definitely better in developed economies, and control of corruption, of course, is better in developed economies. But on the flip side of this is that they are seeing a lot lesser growth, or less dynamic growth. So we can't just talk about Asia as Asia. We have to talk about Asia in certain different economies. So what I'm going to do is to break it down into different economies. First of all, I'm going to talk about Hong Kong. I'm born and raised there, and I love Hong Kong. But Hong Kong right now is seeing a lot of challenges. So last year we heard probably in this region we saw quite some news regarding the Occupy Central movement. That was creating some kind of disruption to the economy because visitors just were afraid of visiting Hong Kong. And that was actually leading to some tension between Hong Kong and China. So whenever I visit China, and I visit China very often, so I would hear from people asking me, hey, what's going on with Hong Kong? What's the deal with that Occupy Central movement? Well, that is actually leading to some soft effect and negative impact on the domestic economy in that sense. Also, earlier this year, we saw a lot of protests between Hong Kong citizens. These protests are quite scattered, but a lot of them happened. Some certain groups of Hong Kong citizens actually protested against Chinese leaders, and we can see on the left-hand side that Chinese visitors actually attribute some 80% of the total visitors to Hong Kong. So when Hong Kong citizens are protesting against Chinese visitors, it's not a good sign. So on that front, we are going to see a slowdown in tourism relevant activities, including but not limited to hotel, retail, and restaurants, food and beverage. On the other hand, Hong Kong is also seeing a lot of headwinds and challenges in terms of the property market. Property market actually got really, really hot in Hong Kong for the past decade or so. We can see in the chart on your right-hand side, the blue line shows you how property prices have increased by three times during the last decade. At the same time, GDP increased very, very barely, and then also income increased very, very barely, just like 20-some%. So there's no way for not normal, but an average person in Hong Kong to actually purchase a property anymore. So that is creating a lot of social uneasiness, and that is why I'm turning a lot negative on the Hong Kong economy. And we do have data to back up. So on an annual basis, Coface in Asia-Pacific region conducts a payment survey to look at how corporates are dealing with the payment behavior in that region. So well, we can see on the left-hand side that there's a rising report of long overdue seen in 2014 comparing to 2013. At the same time, insolvency number actually increased by 3.1% in 2014. So we actually, now that I've talked a little bit about how negative it is in Hong Kong right now, we expect the insolvency number in Hong Kong to go up this year. Okay, now after covering the region or the very small economy that I love, I'm going to talk about a much bigger economy, India. India, back in 2013, it actually faced a lot of issues regarding inflation, regarding currency depreciation and whatnot. That is not quite the case right now. So after Modi went on started his administration last year in May, in the past 1 year, we have seen a lot of positive notes in terms of reforms, in terms of a positive attitude from the investment and business communities from around the world. So that is going to contribute to our positive outlook on the India economy. And businesses actually is supportive of our view too. So from the other side, you can see that businesses are becoming more optimistic. But India is, of course, facing a lot of challenges, and these challenges are really have been lingering for a long time. That includes the fiscal and current account deficits. Well, from us, we believe that, of course, there are a lot of good things that could happen in India. But then, on the other hand, India is really lagging behind in terms of infrastructure development. So think about it that way. If you are a country, if you want to develop your manufacturing sector, of course you need power, because you can have the manufacturing firm there. If you don't have power, you can't run the business. So okay, you need power. And then, okay, after you have done after you have finished your product, you need to send it to somewhere else. So you need toll roads, you need railroads. But like these infrastructure plans, these infrastructure projects are not quite there yet. So it's very difficult for firms in India to actually ship their goods to the other places. Okay, so if you want to export the goods from India to, say, US, you need to have very good facilities in terms of like airports or ports. Well, India is also lagging behind in terms of that front. So, for us to believe that India wants to engage more in the international trade platform, they have to invest a lot more, and that's why we believe that the budget deficit will exist for a long time, for a longer period of time. In terms of current account deficits, well, that is essentially the case. For 2015, we believe that it would be better in the sense that India is actually the world's 4th largest consumer of oil. And so lower oil price should be benefiting India in general. India, well, we try to look at the payment experience in India, but then there's no macro data we can refer to regarding India's payment experience. So we picked up the corporate profitability as a benchmark. We can see that back in 2014, the profitability of Indian corporations are actually picking up a little bit, although it's still at a relatively low level from India's standpoint, but then it's picking up. So we believe that India has a lot of good. We have reasons to believe that India should be picking up in terms of the payment experience. And then on the other hand, in the annual payment survey, we can also see that India corporates are less disturbed by ultra long overdue, which is again a good thing regarding Indian economy. I want to talk a little bit about South Korea. South Korea, when we think about South Korea, we always think about high-tech stuff. Okay, but like Korea is not only about high-tech stuff; it's also attracting a lot of tourists to the country. And from the left-hand side, you can see that well, China is a big contributor to Korea's visitors. So we have to look at this as a way to see how the rise of China is not only going to benefit China, but it also benefits the other parts of the region. On the right-hand side, you can see that Korea's export growth is actually really led by the recovery in the U.S. And since we believe that the U.S. is recovering in this year, we believe that Korea's export is going to benefit as well. However, there are certain issues regarding Korean economy. On the left-hand side, you can see that the property market in Korea is actually quite expensive. It's quite hot, but people are quite reluctant to buy the purchases now, to purchase the home now. So this is good and bad. Is because like if if people are not going to spend too much money in terms of purchasing properties, it's very difficult for developers to actually retrieve the cash flow, and that could potentially lead to some kind of issues. But that issue may not be bothering everyone. We can see that insolvency number in Korea is actually declining by more than 10%. Rather, it's actually at around 15%. So that is a good sign for us who actually look at insolvency and bankruptcies. Thailand was a big trouble back in the last quarter of 2013 and 2015. So it was the political hiccup that was leading to worries regarding the Thai economy. Right now, we have seen the stabilization of the Thai military situation. The military government is really staying on top of issues now. So that is going to be a good thing for the Thai economy. And due to the low base effect that we have seen in 2014, the growth in Thailand this year is actually going to pick up. It is actually quite supported by the tourism figure that we are seeing here. The green line shows you the dynamic growth of visitors visiting Thailand. And the blue line there shows you how the utilization rate of manufacturing firms is picking up too. So it is supportive of a view that Thai economy is going to pick up in 2015. On the right-hand side, leading indicator actually points to more aggressive growth this year comparing to our expectation, but then we have to take note of the fact that these leading indicators do not necessarily translate into real growth. So optimism is there. Whether or not it can deliver such dynamic growth, we have to wait and see. In 2014, we actually conducted the payment survey in Thailand for the first time. So this data actually tells us that much of the overdue is actually held at the very short end. So it is a good way, but then it's just 1 year's number, and such soft data is not may have some distortion, and so I have to wait. And I'm not too sure about this number. I just want to put it here. It is up for the discussion. But then like with longer history of such data, I think it would be more meaningful. Insolvency number in Thailand is actually not really stopping the hiking trend. You can see in here that the insolvency number continues to pick up in Thailand. So that is something that we have to take note of. This is why we are, instead of saying that Thailand will be growing at 6%, we are more conservative, and we believe that Thailand will be growing at around 3.5%. Talk a little bit about Vietnam. Vietnam is now becoming the center of attention in terms of a country that can pick up the slacks from China in terms of manufacturing capacity. Well, Vietnam is actually doing a lot better in terms of controlling the inflation. It's actually doing a lot better in terms of controlling the currency movement. So that is, we think, at least providing us some degree of stability. So that is good. And at the same time, Vietnam doesn't want to just engage in activities of producing very cheap garments. They are now trying to do more in, doing something that is more value added. So they are attracting a lot of investment from Korea. So when you think about Korea, you think about high-tech stuff. So when Korea actually invests in Vietnam, what do you think they're doing? They are investing there for high-tech stuff. So something that they do is the electronic products. You think about the brand, something that starts with S, something that starts with L. Well, they are all present there. So you see that Vietnam will be benefiting from the high-tech investment in the country. And also at the same time, while you are talking about picking up the slacks from China, when China's wages is increasing by around 10% per year, you don't want your wage to actually increase by the same rate. You want it to be slower. So they are actually moderating. The country is seeing quite moderated kind of wage growth. Income level is rising, but it's rising only steadily. So they are keeping the comparative advantage on that front. On the right-hand side, you can see that the country is actually, although we are all crazy and we are all happy about how Vietnam is being a big exporter now. Well, you can see that the net export is actually at very low level. Why is that the case? Because they are importing a lot of stuff too. So we believe that Vietnam has to increase the goods, the higher value-added export in order to see the reversal of this trend. And so, the investment from Korea should be helping. Okay, I finished talking about some countries in the region. Now I focus more on China. This is a picture that I took last year before, right after the APEC summit. So it was APEC Blue that you saw in the news all the time. And I took it with a good phone that started with S. So, like it wasn't bad, okay? So, it was all murky there, but you can tell that in China there are a lot of issues including environmental protection, etc. I'm not going to talk about it because I'm not an environmentalist. But then you can see in here that there are issues here. It is one of those ghost towns. It's just 15 minutes away from Beijing. But then, like I was taking a train from Beijing to Tianjin, and this is just 15 minutes in the middle of it. And then I walked out of the train, and then I realized that, hey, there's only 20 people walking out of the train with me. So I was like, okay, what's going on? And then I was talking to other passengers there, and then they were telling me this is one of those ghost towns. So yeah, it was one of those ghost towns. And you can see in there that there are a lot of canes still, building a lot of buildings out there, and there are plenty of buildings out there. Trust me. So that wasn't quite the thing that we want to do. We don't want to waste resources. We don't want to, create distortion in terms of prices. So yeah, this is something that China wants to fix, and they are fixing it. Before I go into that, I'm going to talk a little bit about our forecast. We believe that China is going to grow 7% this year, comparing to the 7.4% we saw last year. That is, however, not going to come majorly from consumption. I understand that a lot of people actually believe that consumption is the next new growth driver of the Chinese economy, but we do not believe that it will be the case. When you want consumption to grow, you need to have more. You need your people to have more money. So like we have seen, I'll talk about it later. While income is actually growing in China, is growing at a lower pace. So on that front, we believe that consumption should come down as a result of that. Also, it's also because of the anti-corruption scheme that is, haunting retailers in China. And the third point is that, well, now the Chinese passport can actually carry the Chinese citizens to the other countries more easily, more freely. So I guess that is the third point that you would want to take away in terms of the not so fast consumption story. While on the other hand, we believe that investment will be the major growth driver continuously, and I will explain to you in the next slide. Well, the slide after this maybe. So here we can see that like growth in China is actually slowing down, but it's quite steady, I think. It's of course not comparable to the 13.4% that we saw in 2006-2007, but the 7% growth is still really respectful. Why is that the case? Well, for China to with its aggregate economic output is generating, the growth itself is generating an economy of the size of Argentina. So the size really matters. So yeah, we believe that the slowdown in China is actually outplayed, or like the noises is really the noises are really more than what it really means to the world, I think. At the same time, okay, so I will move on and talk about the investment instead. So the left side tells you how consumption is going to slow down because of the slower income growth. Back in 2013, income actually grew by 7.7%. In 2013, it was slow. It was around 9%, but I personally doubt it because I go to China very often, and like I talk to people, and I ask them, hey, well, they're not going to tell me the absolute value, but then the increase itself, it actually means something too. So I asked them, do you feel that you're still the salary increase is picking up a lot? They all say no. They all shake their heads, and they all look unhappy. So yes, I think that the real slowdown, the real story of the slowdown in income growth is actually more than what we are seeing. And by the way, China consumers they are really used to getting income growth of north of 10%. So this is something that we have to take note of. On your right hand side, you can see that. Urbanization rate in China is picking up quickly. It's almost doubling what they were seeing back in 1990s. But it is still low on a relative basis. How do we want to look at it? Well, the United States has an urbanization rate of some 82%. Australia has something like 89%. And then, well, Hong Kong, as a small, tiny economy, we have 100%. So you would be like, hey, Rocky, you are making really, really bad comparison. And now, okay, if we don't want to compare China to a developed economy, we compare it to North Korea. North Korea has urbanization rate of some 61%. So there are reasonable assumptions that we can see China achieving urbanization rate of 60%, and this is exactly something that we are seeing, we're hearing from policy leaders lately. It will not happen overnight, but this is the target they are making for 2020. So this is why, for urbanization to actually happen, China has to put in a lot of money. So this is why we believe that investment will still be the key growth driver of the Chinese economy. Of course, I told you, you don't have to worry about a slowdown in China, but there are certain things that you have to worry about. One thing is the debt issue in China. So here, on your left-hand side, you can see that the aggregate financing to GDP ratio is now at 215% as of the end of first quarter 2015. So it's pretty bad. But it's not only led by bank lendings, it's actually led by the orange part. And perhaps you can't see, but the orange part is the non-bank financing. That includes corporate debt, that includes, the corporate bonds, like trust loan, etc. This is the so-called shadow banking. So, it is that part of the lending that actually affects the leverage level of the Chinese economy. Keep that in mind. And that is why you will hear a lot. You probably heard about it since 2014, but you will continue to hear that. The government will be trying to control the shadow banking facilities in China. In terms of local government debt, we have heard a lot about it. We have to distinguish it. We have to look at it at two levels. On the macroeconomic level, we don't really have to worry about the piling local government debt, because at the end of the day, all the provinces belong to China, Chinese central government. So if let's say a country or a county or a province, sorry, not a country, a county, a province or a city is being overly indebted and they are not they're not able to repay the debt. Well, I think the Chinese government, central government, will be bailing them out. So there won't be Chinese central government would not say, hey, I'm going to give it out and why don't you take it? No, it's not going to happen. Okay. At the same time, we have to look at it at a more micro level. So when you think about local government debt, when local government issues debt, who are the people who are contributing to the debt? Private sector. So as the local government increase the debt, the ability to actually pay down the debt may be getting lower. And so when you are a private sector and you want to lend to the government, and if they are not paying you, then what can you do? So you want to, if your client or yourself is really, well, if a client or yourself is really, putting your money in local government projects, think twice. So here we can see that there are a lot of policies lately that we're seeing from the Chinese government. The monetary policy that we saw was definitely one thing. So we can see that interest rate was being cut several times already. And then we can also see that triple R cut, the required reserve ratio cut, has also been implemented back in February. We are going to see more. Why is that the case? Because Chinese government wants the real economy to be helped. They want the real business, the smaller business, to be helped. They're doing it right, but then I argue that the direct impact may not be as quick, and it will not be as impactful as one would expect. Why is that the case? Because it is it is a structural issue that in China that smaller companies do not have the access. They do not have the access to credit from the regular banking system. So I would like to explain a little bit here, and I think I still have a little bit of time. So the lending cycle starts from depositors. We deposit money in the bank, and bank lend it out to companies. And in China, we always see that banks lend to large companies. So large companies do not necessarily need all the credit facilities they get. but they're going to get it out anyway. Why is that the case? They can lend it out to the others at a much higher interest rate. So large enterprises can borrow money from the bank at around 6%, and they can do the very simple operation by lending it to the others as 12. So they make 6%. And in China, manufacturing sector gets around 2 to 5% net profit margin. So the 6% really matters to them. So the shadow banking facilitators get the money from these large enterprises, and they continue the supply chain through lending it to the smaller enterprises at some 20%. So bear in mind that the small, medium-sized enterprises only make 2 to 5%. The 20% is outrageous. The reversal of this trend is the payment cycle. I'm not going to go it through, but here there are chances that the payment cycle could be pretty bad. So we start with SME. SME, when they go bust because of low profitability, because of financing issues, they go bust. If only one SME go bust, then it's okay for the shadow bankers. But if a bunch of them go bust, which by the way happened in 2011, and we do see a chance of happening again in 2015, then it would disrupt the entire lending cycle. So this is something that we see. That is something that we at Coface would like to address. We would like to look at it more carefully. This is not my job to look at it, but also the underwriter's job. So we are doing it pretty well, I think. Here on the left-hand side, you can see how people are actually paying some north of 20% interest rate in Wenzhou. And by the way, this is, again, official data. I did not come up with some random data. This is official. So you can see how the 20% really matters in reality. And trouble, of course, occurs in China. So from the non-performing loan that is in the regular banking system, we can see that on an aggregate basis, it actually increased by 42.3% as of the end of 2014. 42.3%. It is pretty massive. So issues we have to understand that the China banking system is actually quite prudent, and they have a lot of good risk experts and looking at the issues. And non-performing loans still increased by 42%. So that is really bad news. Okay, so the property market was a big issue back in 2014, and we expect it to continue this year. An indicator like this, real estate climate index, is really showing us that it is continuing. Right now, the blue line here on your left-hand side is still bottoming, and it has already bottomed to a level that was unseen since the data was created in year 2000. The last trough that we saw was first in 2009 when global financial crisis was there. And in 2012, when GDP actually slowed down by 6 consecutive quarters, at the same time, a lot of provinces and cities were introducing the house purchase restriction to clamp down on the soaring property prices in China. So, and we are at a level that is even worse than that. Why is that the case? I'm going to talk. Oh, I didn't have that slide, but then why is that the case? It's because of two different things. So from the operation side, the transaction volume is actually coming down. So property developers do not have the normal cash flow coming back to the pocket from cash flow from operation. On the other hand, since the government is really clamping down on the shadow banking facilities, well, the property market cannot get facilities for financing purposes as well. And we have to remember that the property market actually relies on shadow bankers for credit facilities. Around 40% of the 44% back in 2013 and 40% from 2014 was actually coming from shadow bankers, other resources. So this is something that we have to see. The clampdown of shadow banking activities is going to have the impact on different sectors in the economy, and property sector is certainly it. So here on this slide, I'm going to go through it very quickly. Monetary, we can't expect PBOC, or the Central Bank of China, to do funny stuff. So monetary policy is the only thing that they can do. Reducing RRR, reducing interest rate is something that they are going to do. In the middle, we can see the fiscal policy. Fiscal policy is going to be more supportive this year. It's not a stimulus, it's support. So we have seen from the communication from the government that they are ready to expand fiscal deficits to 2.3% this year, comparing to the 1.8 last year. So that actually indicates to us that the government is going to expand stimulus or support. So we are going to see that. Don't worry. For the structural issues, I'm not going to go through it, and we can talk about it later. From Coface, we do an annual payment survey in China, and this year we saw that 80% of the companies in China, among the 900 that we surveyed, have seen overdue experience. It seems to us that it is improving a little bit from 2013, but we have to remember that 2013 was a really bad year in China, and so it's only stabilizing at a very bad level. And we also saw that 57% of the companies saw the overdue amount increased over the last year. So again, that is another bad sign. At the bottom, you can see that average overdue days of the sales. Actually, there was an increase in terms of respondents saying that overdue was held at the long end. So that is, again, a bad sign. So, by the way, from our very own experience, Coface experience says that if your customers do not pay you and is overdue by 180 days, there's an 80% chance that you are not going to get it back at all. So this is I think it makes sense to you. So in the report that we published earlier in March, we talk about different sectors, and most of them are actually seeing bad signs. So a lot of talking. Right now, I want to tell you how we actually assess these risks. So there are two things that we do. Business climate assessment is one thing, and the other is called country risk assessment. Business climate assessment, we do it on an annual basis. We look at, we don't look at sovereign risk. We look at company corporate risk. So we look at how business environment is doing. We look at whether or not financial information regarding corporate sector is available, and whether the information is reliable. So for some countries, information is available and is too available. For instance, when I talk to our counterparties in India and in China, they always talk about the 3-book rules. So you would scratch your head and what is the 3-book rules? It is a book that is kept for yourself, like the real detail. Then the other book is for the government, and the other part is for your investors. So you have 3 sets of financials. Then availability is there, but then it's not really reliable. So we look at it from a country's business climate perspective, and a lot of things that I talk about economics, about profitability of different industries. Well, it is used as a part of our country risk assessment, and we also use our very own payment experience there and put it into 7 grades. A1 to A4, B, C, and D. We do it on a quarterly basis. I'm not going to go through it. This is something that you can see on our website, but we have seen something bad in China, and I already talked about it. So back in January, we put a negative watch on China's A3 assessment. And so this is what it is. Thank you very much for your presentation. Thank you very much for your attention to my presentation. Thank you.